Welcome to today's deep dive. We're really thrilled to have you with us today. You know, when you download an app to your phone today, there is a very deliberate expectation of a completely frictionless experience.
Oh, absolutely. It's all about speed.
Right. You tap a brightly colored button, Face ID scans your face for like a fraction of a second, and boom, you are immediately inside the ecosystem.
Yeah, the entire user interface is engineered from the ground up to completely obscure the underlying complexity. I mean, the goal is to make the technology feel practically invisible to the user.
And that works beautifully for ordering a pizza, right?
Right.
Or, streaming a movie. But when you apply that exact same frictionless kind of gamified design to a retail financial trading platform, things get complicated.
Extremely complicated.
Suddenly, that smooth glass exterior is masking an absolute labyrinth of legal plumbing, leveraged financial mechanics, and just dense fine print. You aren't just playing a mobile game on your commute, you are wiring your personal bank account directly into the volatile currents of the global financial system.
It is the absolute definition of a high-stakes environment.
Yeah.
And we tend to lose sight of that severity when the interface mimics the simplicity of social media,
Yeah, exactly.
The psychological distance between tapping a screen and risking actual capital is dangerously thin.
Which is exactly what brings us to our focus today. We're taking a magnifying glass to an independent, incredibly detailed source review of AvaTrade.
Right, a major player.
Yeah, for those who track the retail Forex and CFD space, they are one of the longer-standing names out there. So, our mission for you today is simple. We want to cut through the dense financial jargon, push past those glossy marketing banners, and examine the actual structural mechanics of their platform.
The nuts and bolts.
Exactly. We want to uncover whether this broker, which, by the way, has been operating for nearly 20 years, is a reliable, well-built environment for your capital, or if there are structural catches you absolutely need to factor in before you ever hit deposit.
What's fascinating here is that while countless brokers market themselves by selling a fantasy lifestyle, the cliche of the trader lounging on a tropical beach with a laptop.
Oh, always a beach, and usually a sports car somewhere in the background.
Right. But if you want to know how a broker actually operates, you ignore the marketing completely.
Yeah.
You examine their regulatory footprint and the specific mechanics of their fee structure.
Follow the money.
Exactly. Those two elements strip away the noise and reveal their true business model. It tells you mathematically who they're built to serve, and just as critically, who they are actively trying to filter out.
Okay, let's unpack this, because before we get into the complex mechanics of how your orders are actually routed and executed in the market, we first need to understand the sheer, overwhelming scope of what AvaTrade actually is.
It's massive.
It really is. According to our source review, the company was founded in Dublin back in 2006. So nearly 2 decades in the retail margin trading industry. I mean, that is practically ancient history in this space.
Oh, absolutely. Most brokers in this sector barely survive their first 5 years.
Right.
So longevity in retail derivatives is a very distinct data point.
Yeah.
Surviving multiple global market cycles, banking crises, and, sweeping regulatory overhauls requires a level of institutional resilience that a fly-by-night operation simply cannot fake.
Yeah, and over that time, they have aggregated a massive array of financial instruments that you can access from one single account. We are talking major and minor Forex pairs, individual global stocks, broad market indices, commodities, ETFs, government bonds, and crypto.
It's an enormous menu.
It is. To me, looking at this, it functions exactly like a giant financial superstore. You walk through the doors and you can buy a loaf of bread, a new flat-screen television, and a set of car tires, all at the exact same checkout register.
That's a great way to visualize it.
But I have to push back on this concept just a bit. Honestly, when I see a platform trying to be everything to everyone, I get deeply skeptical. Yeah. Does being a jack of all trades mean the platform is actually a master of none? Like, a highly specialized veteran trader would look at this massive menu and run the other way, wouldn't they?
Well, that skepticism is entirely warranted. The superstore model inherently demands compromises. It really depends on the mechanical requirements of your specific trading strategy.
Okay, give me an example.
So, if you are a swing trader or someone looking to construct a cross-asset portfolio, let's say you want to short the euro-dollar pair based on morning economic data.
Okay.
And then you want to hedge that by taking a long position on tech ETFs in the afternoon. Having all of those distinct asset classes routed through a single unified margin pool is structurally brilliant.
Because it's all in one place.
Exactly. It eliminates the friction of maintaining separate balances, managing capital allocation across 5 different brokerages, and dealing with disparate reporting software.
So for the cross-asset strategist, the breadth is the primary feature.
Precisely. But consider the absolute opposite end of the spectrum. Take a pure Forex scalper.
Right, the person making 100 trades a day.
Exactly. A trader who executes hundreds of automated algorithmic trades per day on a single currency pair, aiming to capture fractional pip movements. For that trader, the fact that AvaTrade offers hundreds of stocks and ETFs is completely irrelevant noise.
Right, they don't care about a tech ETF.
Not at all. What the scalper requires is ultra-low latency, raw direct market access spreads, and massive depth of book. The infrastructure required to seamlessly quote thousands of diverse assets usually precludes the hyper-specialized, razor-thin environment that a scalper demands.
Okay, so yes, for the hyper-focused algo trader, the superstore model is entirely the wrong architecture.
Exactly.
But holding all of those different asset classes in one place creates a massive single point of failure, doesn't it? If AvaTrade is this giant superstore, what happens if the roof caves in?
That's the million-dollar question.
Right, because a vast array of tradable assets is structurally useless if the legal entity holding your money isn't bound by ironclad laws to protect it. And our source material highlights regulation as one of their heaviest anchors.
It really is.
They currently hold operational licenses across 10 different global jurisdictions.
10 separate licenses is a very deliberate corporate strategy. Most brokers actively avoid that level of global scrutiny because compliance is incredibly expensive.
Yeah, the review calls out several specific heavyweights. The Central Bank of Ireland, which covers European traders under the MiFID framework.
Right.
ASIC in Australia, the Financial Services Agency in Japan, CISC in Cyprus, the FSA in South Africa, and the ADGM down in Abu Dhabi. So what does this all mean?
What?
Why does this actually matter for the person hitting buy? What is the structural difference between holding these 10 specific licenses versus just, setting up a single offshore corporate shell on a tropical island somewhere?
We really have to differentiate between a regulatory badge and a meaningful signal. A single offshore license allows a broker to legally process financial transactions. It makes them a registered entity, and that is about it.
It's just a piece of paper.
Exactly. It does not enforce any rigorous structural protections for the client's actual capital. Top-tier regulatory bodies like the Central Bank of Ireland or ASIC are not merely rubber stamping business applications. They are subjecting the broker to constant invasive audits.
Wait, what are they auditing for on a mechanical level?
The foundation of Tier 1 regulation is the strict enforcement of segregated client funds. This is a critical structural mechanism.
Okay, how does that work?
When you deposit your capital, it does not flow into AvaTrade's corporate operating accounts. It is legally mandated to be held in entirely separate, ring-fenced trust accounts at top-tier banks.
Meaning there's a firewall between the money they use to run their business and the money I use to trade.
A literal legal firewall, yes. If the broker suffers a catastrophic failure, let's say a sudden market shock wipes out their corporate liquidity and they're forced into bankruptcy.
Okay.
The liquidators and corporate creditors cannot touch your segregated funds to pay off the broker's debts. Your money belongs to you, not the broker's estate.
Wow. That dramatically shifts the counterparty risk.
Exactly. Furthermore, these specific regulators enforce severe capital adequacy rules. The broker must continually prove mathematically that they possess enough of their own liquid cash reserves to absorb massive, unexpected market volatility without going insolvent.
So while having 10 licenses obviously cannot protect you from making a bad trade and losing money to the market.
Oh no, that's still on you.
Right. It ensures that the plumbing of the platform itself is resilient. The broker is constantly proving its financial solvency to separate independent government watchdogs all over the globe.
That's exactly it.
All right, so the Superstore has a massive inventory, and we know the structural foundation keeping the lights on is heavily fortified. But how do you actually engage with the market?
The trading platforms.
Right. The source material details the trading toolkit, and it spans a pretty wide spectrum. You have the legacy industry stalwarts, MetaTrader 4 and MetaTrader 5, which most algorithmic or veteran traders are already deeply entrenched in.
Very familiar territory for a lot of people.
Yeah. Then there is their proprietary WebTrader, which functions entirely in the browser, and their custom iOS and Android mobile apps. But what jumped out at me initially was a small detail about their demo account.
Oh, the unlimited demo.
Yeah, the review notes that the demo account is completely unlimited. Why is that notable? Because brokers offer demo accounts all the time.
It is notable because of behavioral psychology. The industry standard for retail brokerages is a strictly enforced 30-day limit on demo accounts.
Oh, so it's a countdown clock to force a decision?
Yes, it is a high-pressure sales tactic. It gives you just enough time to learn which button executes a trade, but nowhere near enough time to properly backtest a mechanical trading strategy across varying market conditions.
Right, because markets change week to week.
Exactly. When the 30 days expire, the psychological pressure kicks in. You either fund the account with real capital or you lose the workspace you just spent a month configuring.
That's brutal.
By removing that artificial time constraint, AvaTrade allows a user to forward test a strategy for 6 months if they need to, evaluating how the platform handles execution during different news cycles without any forced conversion pressure.
That is a subtle but telling choice. But here's where it gets really interesting. Beyond the standard platforms, the review zeroes in on 2 highly specific proprietary tools, AvaOptions and AvaSocial.
Right, these are standout features.
I want to spend a minute dissecting AvaOptions. The source explicitly points out that this platform is built exclusively for trading vanilla options, and it notes that this is exceedingly rare for a retail CFD broker to offer. Let's break down the mechanics. How does the risk profile of a vanilla option fundamentally differ from the standard leveraged CFDs that retail traders are usually dealing with?
This is a vital distinction because the underlying mathematics completely alter how you interact with market risk. When you trade a standard CFD, a contract for difference, you are trading linearly with the asset's price, and you are using margin.
Okay, wait.
If you buy a CFD on the S&P 500 and the index drops steadily for a week, your position is absorbing those losses point for point. Because of the leverage, the size of that loss can vastly exceed your initial margin requirement, potentially draining your entire account balance if you don't utilize a hard stop loss.
Right. Let me offer an analogy to see if I have the mechanics straight. Trading a CFD is essentially like buying the fuel tank of a private jet. If the market value of jet fuel plummets, the value of what you hold drops right along with it, tick for tick, and you absorb the entire financial blow.
That is mechanically correct. The exposure is continuous and linear. A vanilla option utilizes a completely different architecture.
Okay.
An option is a derivative contract that grants you the right, but crucially not the obligation, to buy or sell an asset at a predetermined strike price on a specific expiration date.
The operative phrase being that it is a right, not an obligation.
Exactly. To acquire that right, you pay an upfront, non-refundable cost called a premium.
Sort of like a deposit.
Similar, yeah. This premium is calculated based on complex variables like time to expiration, market volatility, and how far the current price is from your target strike price. Let's say you analyze the market and pay a $200 premium for a call option, betting that oil prices will spike.
Okay, betting on oil.
If you are entirely wrong and oil prices collapse instead, you simply choose not to exercise your right to buy. The option expires worthless.
And what is the total damage to the account?
The maximum possible loss is strictly confined to the $200 premium you paid to open the contract. It is mathematically impossible to lose more than that initial premium, regardless of how far the underlying market crashes.
So, returning to the airplane analogy, buying the vanilla option is like purchasing a non-refundable flight reservation.
Yes.
If you get to the airport and decide you don't want to fly or, the weather turns terrible, the absolute worst case scenario is that you lose the cost of the ticket. The airline cannot charge you for the plane's maintenance just because you didn't board.
That captures the dynamic perfectly. The risk is asymmetrical. For a retail trader who struggles with the psychological discipline of cutting losing trades, or who fears massive overnight market gaps blowing past their stop losses.
Which happens all the time.
Exactly. Knowing your absolute maximum downside to the exact dollar before you even enter the trade is a profound shift in risk management. The reason most retail brokers avoid offering this is that pricing vanilla options correctly and hedging that risk on the broker's back end requires incredibly sophisticated liquidity engines.
So it's much easier for a broker to just offer linear CFDs.
Much easier, yes.
Okay, that makes the inclusion of AvaOptions a major structural advantage for risk-conscious traders. What about the other proprietary tool, AvaSocial? The review outlines this as their dedicated copy trading environment where users can automatically mirror the positions of veteran traders.
Right, copy trading is very popular right now.
But the source highlights a very specific constraint here. AvaSocial is exclusively mobile-based. There is no web interface, no desktop application. It exists only on your phone. Why would they restrict a financial tool like that?
That restriction is actually a brilliant piece of behavioral design. Think about the physical posture of a trader at a desktop computer.
They're hunched over.
They are leaning forward, studying charts, analyzing volume, actively managing risk. A desktop environment encourages active, granular participation. By forcing copy trading onto a mobile-only interface, the platform fundamentally changes the user's posture.
It turns it into a passive consumption feed, like scrolling through Instagram.
Precisely. It signals that copy trading is not meant to be actively micromanaged. It is designed to be a passive allocation strategy that you check on the train or glance at while standing in line for coffee.
I see.
It treats the veteran traders you are copying more like mutual fund managers. You allocate the capital, and then you step away.
However, for a trader who insists on viewing their entire portfolio holistically on a multi-monitor setup, being forced to pull out a smartphone just to check their copy trading performance creates an irritating operational silo.
Oh, it would be incredibly frustrating for that type of user.
All right, we've mapped out the sheer size of the superstore, we've validated the structural integrity of their legal firewalls, and we've examined the tools on the shelf, including the unique risk profiles of vanilla options. Let's shift our focus to the cold, hard numbers.
Let's talk about the money.
Let's examine the actual toll required to access this infrastructure.
Right, the barrier to entry and the hidden costs of maintenance.
According to the source, opening an account involves the standard KYC verification which anyone in this space expects. The minimum required deposit is listed at an incredibly low $100.
Which is very accessible.
Extremely. Funding options are vast, major credit cards, wire transfers, and popular e-wallets like Neteller and Skrill. Interestingly, though, the review notes that those specific e-wallets are blocked for clients residing in the EU or Australia. Why would the broker restrict funding methods based on geography?
That restriction is the direct consequence of those top-tier regulators we discussed earlier. The Central Bank of Ireland and ASIC enforce incredibly stringent anti-money laundering directives.
Okay, so it's a security thing.
Yeah, e-wallets can sometimes obscure the original source of funds, making it harder to track illicit capital flows. So the regulators mandate that funding must come through highly transparent traditional banking channels.
That makes perfect sense. It's a compliance bottleneck, not a platform glitch. Now, regarding that $100 minimum deposit, the review offers a rather blunt reality check. They explicitly state that while $100 technically unlocks the platform doors, actually deploying a coherent strategy across this massive range of assets practically demands a working balance closer to $1,000 or $2,000. Let's explore the math behind that. Why is $100 insufficient?
It revolves entirely around the mathematics of position sizing and the realities of margin. Let's assume you deposit exactly $100.
Okay.
If you want to take a position on a volatile tech stock, the margin required just to open that single trade might tie up $30, $40 of your equity. You have now allocated 40% of your total account capital to a single market variable.
Which violates every basic rule of risk management.
Exactly. If that one stock experiences a sudden intraday drop, you have no excess margin to absorb the volatility. The broker's automated risk systems will trigger a margin call and liquidate your position to protect against a negative balance.
So you're just out of the game immediately.
You simply do not possess enough runway to diversify your risk across different assets. A $1,000 balance mathematically allows you to risk only 1% or 2% of your total capital per trade, which is the institutional standard for long-term survival.
So $100 is basically just the price to walk through the door and look around, but you need a larger cart if you actually plan to shop.
Exactly.
Which brings us to how the broker actually extracts revenue from your trading. The review details that standard retail accounts operate on a spread-based fee structure, meaning there are no flat per-ticket commission charges when you execute a trade.
Right.
There are also standard overnight premiums applied if you hold a leveraged position past the daily rollover point. Can you demystify that overnight premium? Why are you charged just for holding a trade?
The overnight premium is fundamentally the cost of financing. When you open a highly leveraged CFD position, you are effectively borrowing capital from the broker's liquidity providers to control a larger market position than your account balance would normally allow.
It is essentially a short-term loan.
Exactly. And capital is never free. That overnight fee represents the interbank interest rate differential between the two assets you're trading, plus a small markup taken by the broker for facilitating the leverage. If you hold the position for weeks, that daily financing cost slowly eats into your profit margins.
Right. And regarding the spread-based execution model, if I don't pay a $5 commission fee to place a trade, how is the broker generating their primary revenue?
If we connect this to the bigger picture, The broker acts as the bridge between you and the broader market liquidity. In any market, there's a constant spread between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept.
The bid and the ask.
Yes. The broker accesses the raw underlying interbank spread, which might be essentially zero, and they artificially widen it by a fraction of a pip before passing the quote to your screen.
So they mark up the wholesale price?
Correct. That tiny markup is their embedded fee. They capture that widened spread every single time you open and close a position.
Which leads us directly to the most controversial detail in the entire source review. Because of that specific revenue model, AvaTrade implements what I can only describe as a ghost town tax and inactivity fee.
Ah, yes. The inactivity fee.
If your account registers 0 trading activity for 3 consecutive months, they deduct a $50 penalty. If that inactivity stretches to 12 months, they add a $100 annual administration fee on top of it. This feels exactly like a predatory gym membership that aggressively fines you for failing to show up to the treadmill.
It does feel that way.
Why would a financial institution actively penalize a client for doing nothing?
You have to look at it through the lens of their back-end infrastructure. Because they do not charge monthly account maintenance fees or flat commissions, a dormant account generates absolutely zero revenue.
Right.
Yet the broker is still incurring hard operational costs. They are paying for the server space to host your encrypted data. They are paying compliance officers to include your account in those massive regulatory audits for 10 different jurisdictions, and they must hold segregated capital in reserve against your balance.
So an inactive trader is essentially a slow financial leak on their balance sheet.
Mechanically, yes. But beyond the operational costs, it is a piece of hostile behavioral architecture. The fee is designed to force a decision.
What do you mean?
It acts as a psychological cattle prod, nudging the user to either re-engage with the market and cross that spread, or withdraw their funds entirely and close the account so the broker can wipe the data from their active servers.
Wow. The review is very clear that this fee is explicitly outlined in the terms and conditions. I mean, it isn't hidden.
No, it's right there in the fine print.
But it acts as a severe trap for a very specific archetype, the casual dabbler. The person who gets enthusiastic, funds an account, actively trades for a few weeks, and then gets distracted by life.
Which happens to a lot of beginners.
Right. They go on a long vacation, or they decide the market is too volatile right now, and they simply step away, assuming their capital is resting safely. 6 months later, they log back in to find their balance hollowed out by administrative penalties.
An algorithmic day trader will never even know this fee exists. But if you treat a spread-based brokerage account like a long-term savings account, the structure itself will literally consume your capital.
Let's synthesize all of this data and wrap up today's deep dive. Based on the exhaustive review of their platform mechanics, AvaTrade operates as a highly regulated, deeply established financial superstore.
That's a solid summary.
The gateway to entry is structurally accessible, and they provide a massive ecosystem of platforms. This includes the highly advantageous risk-capping architecture of vanilla options, alongside the passively designed mobile copy trading environment. However, because the entire operation is sustained by spread markups, it absolutely requires your ongoing active participation.
You can't just set it and forget it.
Exactly. If you abandon your cart in the aisle and walk away, the inactivity fees will aggressively start ringing you up.
This raises an important question, though, and it's one you should weigh carefully before funding any retail account. In an era where complex financial derivatives are constantly accessible via the supercomputer sitting in our pockets, does an architecture that explicitly penalizes you for stepping away actually force you to be a more disciplined, attentive manager of your capital?
That's an interesting way to look at it.
Or does it create an artificial psychological pressure to execute substandard, impulsive trades in a volatile market simply to reset the inactivity clock and avoid a fee?
That is a brilliant tension to consider. The frictionless UI of the app completely obscures the mechanical reality that the underlying machine constantly demands to be fed. Take some time to ponder how your own behavioral habits align with that structure before you wire over that first deposit. Thank you for joining us on this deep dive. We'll catch you next time.